Welcome back to Wealth-ology. For today's video, we will be going to talk about how to invest during high inflation by Peter Lynch. Let's get started. We recently got new inflation data a week or two ago, and it shows that the annual inflation rate in the United States has climbed again. Inflation is currently running at 7% per year. As a result of increasing inflation, Jerome Powell and the Federal Reserve are planning to 3 rate hikes this year, aka they want to stifle the economy and slow down business. But of course, raising interest rates has the unintended consequence of making businesses and stock markets less appealing. Super safe government bonds become more appealing. But this does not necessarily indicate the stock market will fall. However, a high interest rate environment exerts far more pressure on the stock markets than a low rate environment. And this has concerned investors who have had significant gains in recent years, but are now experiencing a decline, worried that when interest rates rise, those advantages would not be sustained and that the opposite may occur. Especially now that inflation has surpassed 7%, in the media, the doom and gloom narrative is gaining traction, which only serves to exaggerate the severity of the situation. A big negative headline, front and center on major news sites, is difficult to escape these days. That has nothing to do with inflation, interest rates, or the Federal Reserve. However, with all the chatter and concern about inflation and interest rates, always reminds me of something Peter Lynch, the author of One Up on Wall Street, stated in 1994. Quote,
"No one can predict the stock market. They try to predict the interest rates. I mean, this is it. If anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logic, so I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market's going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rate's going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that.
We feel like we're getting drawn into market prediction territory at all times. We just watch that, and it really drives home the point that market forecast and interest rate estimations are a constant in stock market. This is a 1994 lecture, and the main topics of discussion were whether the stock market would crash and what interest rates would be. But did it make a difference? Have you ever taken a finance or economic class where the professor discussed interest rates in 1994 and how they influence the stock market's long-term performance? No, because that was completely irrelevant. The SP 500 was at 460 points back then, but it is now at 4,600 points. That subject was being discussed as if it needed to be resolved, or investors would face doom and gloom. Inflation interest rates like the be-all and end-all of the markets.
Alan Greenspan's a very honest guy. He would tell you that he can't predict interest rates. He could tell you what short rates are going to do in the next 6 months. Try and stick him on what the long-term rate will be 3 years from now. He'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it? So I think that's, but you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen.
That is the crucial message for investors and anyone worried about inflation, interest rates, or a recession should watch that video a million times. There are a few things I'd want to know. What will the SP 500 be in a year? Or what will interest rates be in 2 years? But you don't realize it. Nobody does. Yes, inflation might run rampant, and yes, interest rates would be raised to 15%. The stock market might drop by 30%. However, you will not know if or when this will occur. As an investor, what you really need to do is accept, as Peter Lynch put it, that the market is going to go down sometimes. You know, market declines happened. No one predicted the pandemic. Boom! It hit the US and the market tanked 30% at the start of 2020. Tell me that series of events was going to occur in October 2019. Nobody knew that just a few months later, their portfolio was going to be worth 30% less. So, the thing to do as an investor is to accept that these events will occur and accept that they will catch you completely out of the blue. If you're at peace with those two things, then you can start to get in a better frame of mind as to how to approach your investing. And spoiler alert, it's to always maintain a long-term mindset.
Well, obviously the market's gone up tenfold since I stopped running Magellan. So you make more money on the upside. The market's going to be a lot higher in 10 years from now, 20 years from now, 30 years from now. Trying to predict the market is really a waste. I don't know what it's going to do. It can go down. When I ran Magellan, 13 years, it declined 10% or more, 9 times the market. Wow. I had a perfect record. I went down more than 10% every time. Wherever the market went down, I went down more. But over the long term, the upside is more than the downside. So you got to say to yourself, do I need the money in the next month? Do I need the money in the next year? Do I have kids going to college? Do I have a wedding coming up? Then you're a bad investor. If you can keep putting money in, you have 5, 10, 15, 20, 25 year, you should do well.
There you go. The market goes down. You won't see it coming and it will sting you at some point along your investing journey. With that in mind, what are you going to do? As Peter Lynch just said, if you're investing money that you need in the short term to make a quick buck in the market, then you're a fool. If you're investing money, you'll need to pay rent. If you're investing money, you'll need for your kids' tuition. If you're investing money, you need for the upcoming wedding. Then you are a bad investor because the market might go down in the short term. Remember, we don't know when it's going to happen, and if it does happen to go down in the short term, then you're screwed. However, if you invest money that you don't need, you can add to your portfolio over the course of 10, 20, or 30 years. You should do exceptionally well. So, in Peter Lynch's opinion, at the end of the day, the answer to the topic of how to invest at a period of rising inflation, how should we invest when interest rates are likely to rise dramatically, is it we should approach it in the same way that we usually approach investing. Not speculatively, but rationally. Recognize that horrible things will happen. You already know you're going to get it at some point. That could happen at a time when inflation is high and interest rates are raised off. Or it could happen tomorrow at 2:41 p.m. But who cares? Keep sensible. Stay focused on the long term and you'll be fine investing in the market at those times. But it ultimately boils down to your investment temperament. Do not be swayed by the news, speculations, or fear.
So there's always something to worry about. And the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is, and I'm ready for questions.
So which of the topics for investing tips of Peter Lynch have you found to be particularly beneficial? Please let me know in the comment section below, and if you like this video, please give it a thumbs up. Turn on the notification bell and subscribe to our channel for more. Thank you for taking the time to watch. Stay tuned for our next video.